Let's talk about interest rate. Interest rate can be defined many ways. Here, we can say interest rate is cost of money, or cost of holding money, or borrowing money, or rate of return, or price of money. Well, some macroeconomic factors affect interest rates, such as inflation, government budget, the Federal Reserve policies, and international factors. If inflation is expected, then lenders want to charge some extra amount, right? So if we expect inflation will happen in the future, then lenders will increase interest rate on loans. Well, basically because the value of money in the future will go down. When government budget is in deficit, then government need to borrow money. If government borrows money in finance market, then demand for money or credit goes up. So cost of borrowing money will go up. In other words, interest rate can go up. And the Federal Reserve, which is the central bank of the United States, can reduce supply of money or increase supply of money. By doing that, they can increase interest rate. The Federal Reserve can increase interest rate or decrease interest rate. Some international factors, such as inflation also in other countries, or interest rate in other countries, can affect interest rates in the United States. Now, interest rate can be defined in many ways, but in finance, interest rate is promised rate of return, and it depends on investment opportunities and time preferences and risk in investment. What are the determinants? How interest rate in money market is determined? Interest rates are determined in money market by demand and supply of loanable fund. When we say loanable fund, that means total amount of money and credit available for loan. What is the difference between money and credit? Nowadays, credit and money are used interchangeably, but for in definition, money does not generate interest, but credit does generate interest payment, interest income. So that's the difference. But anyway, total amount of money and credit that is available for loan is called loanable fund. So total amount of loanable fund in this graph, total amount of loanable fund is on horizontal line, and interest rate on vertical line. Let me use little r. The small r is interest rate, and loanable fund supply curve looks like that. Demand for loanable fund is that. So here's market equilibrium rate of return, or market equilibrium interest rate, and here the amount of dollar amount supplied in money market. So basically, interest rates in the finance market are determined by in money market or loanable fund market by demand for or supply of loanable fund. Let's go over some important interest rate in the United States. The federal fund rate is short-term interest rate applied on loans between commercial banks. Commercial banks such as Bank of America, Wells Fargo, or other small or medium-sized banks borrow money each other every day. So those loans are a short-term loan, less than 24 hours, and federal fund rate is determined among those commercial banks. Federal fund rate is so a short-term loan. And discount rate is interest rate applied to loans. When commercial banks borrow money from Federal Reserve banks, and then that interest rate on that loan is set by the Federal Reserve banks. There are 12 Federal Reserve banks in the United States, right? Now, prime rate is, so let me go back to federal fund rate, discount rate. These two are the benchmark for other interest rates, such as prime rate. Prime rate can be computed, can be generated by each commercial bank, using federal fund rate, such as Bank of America add 3% on federal fund rate to figure out what's their prime rate, such as they calculate, they figure out what's going to be prime rate. So prime rate is a bank, so lender, right? Lender's rate applied to the best group of borrowers, mostly well-known companies, well-known big companies. When we say yield rate, it is interest rate on bonds. Mortgage rate is long-term interest rate applied on housing loans. 10-year Treasury bond rate is yield rate on Treasury bond with 10 years of maturity. This 10-year T-bond yield rate is the benchmark, the base for long-term loans. Now let's look at the factors affecting market interest rate, small r. Here, when we say r, it is quoted interest rate, or we can say it is nominal interest rate. This little r star is real interest rate. Real interest rate plus inflation risk premium, and then default risk premium and liquidity premium plus MRP as maturity risk premium. Inflation risk premium is when investors or lenders estimate some inflation in the future. If inflation, some higher inflation is estimated, lenders want to add some additional charge on interest rate. So nominal interest rate can be real interest rate, that is what the lenders want to get as their income, plus inflation premium. Actually, this is from Fisher equation. Economist Fisher found there is a relationship between expected inflation and nominal interest rate. So if people think, or investors or lenders think estimate inflation rate goes up in the future, then they want to charge higher rate of interest rate, that is inflation risk premium. Default risk premium is, well, risk premium when borrowers don't pay back, right? Borrowers don't pay back, then that's default risk premium. So when we want to borrow money from banks want to check our credit score, right? To figure out default risk premium. Now, liquidity premium is a premium for the risk of risk of difficulty of liquidating the bond or financial assets. Maturity risk premium is happens at maturity. If reinvestment is difficult or it costs some amount, then lenders lose some amount of money. Then that's why they can add, lenders can add maturity risk premium. Now, when we say risk-free interest rate, usually we talk about the T-bond yield rate or T-bill yield rate. Risk-free means risk-free from there is no default risk or liquidity risk or maturity risk. Risk-free means free from these three risks, not free from inflation risk, because inflation can affect every part of the economy. So R subscript RF, that's risk-free interest rate, equals real interest rate plus inflation premium. The yield curve is to show the relationships between yield rate and maturity. And we can get some signals from the shape of the yield curves about the finance market. Let's say this yield curve, the top one shows some kind of downward sloping, right, between yield rate. This is yield rate and years to maturity, right? Year to maturity, downward sloping, and then these two shows upward sloping. Normally, mostly yield curves look like that, like upward sloping. Let's see why yield curves look like that. Upward sloping yield curve is because inflation premium is increasing. That means people have inflationary expectations. That's inflation. That means people expect price level will go up in the future. The other one, downward sloping yield curve, shows like that, well, because of inflation premium is going down. That means, well, price level will go down in the future. So that is the the cause. That was the factor why yield curves can be upward sloping or downward sloping. Mostly, if downward sloping yield curve will indicate we are going to have a recession in near future. Let's see where some hypothetical yield curves. Let's say this is kind of T bond yield curve. Then corporation yield curves, corporation yield rates are not free from default risk, liquidity risk, or maturity risk, right? So corporation bond yield rate looks like that. Yield rate, or maybe highly rated, such as AA rate of corporation bond, or corporation bond of such as C grade, like that. That means risk is high, right? Default risk or liquidity risk is high, so that is high risk, high yield. We will discuss later this again.